So we're absolutely delighted to have Joel Tillinghast here with us today. Joel Tillinghast is a portfolio manager in the equity division at Fidelity Investments. In this role, Mr. Tillinghast co-manages Fidelity's low-price stock fund and Fidelity's Series Intrinsic Opportunities Fund, as well as portfolios available exclusively to Canadian and Japanese investors. Prior to assuming his current role in December 1989, Mr. Tillinghast worked as an analyst covering coal, personal care, appliances, natural gas, and tobacco at Fidelity. Before joining Fidelity in 1986, Mr. Tillinghast held various other positions, including Director of Research and Strategy at Bank of America Futures, Research Economist at Drexel Burnham Lambert, and Analyst at Value Line Investment Survey. He has been in the financial industry since 1980. Joel Tillinghast is also the author of Big Money Think Small, Biases, Blind Spots, and Smarter Investing, one of MoneyWeek's 5 best books of the year in 2017. Mr. Tillinghast earned his Bachelor of Arts degree in Economics from Wesleyan University and his MBA in Finance from the Kellogg School of Management at Northwestern University. Excellent. So thank you so much for joining us today, Joel. Can you discuss a little bit about your thoughts in investing in Japan?
Japan is a parallel universe. It's an island country, and the Japanese stock market peaked out in 1990 and has not recovered the heights that it reached during the colossal bubble that they've had. Mrs. Watanabe, which is sort of the Japanese name for retail investors, since Mrs. Watanabe is a common name, and it happens to be the married name of one of my sisters. So I say it with affection. Has been out of the stock market for many years because the results have been so disappointing from there. The result is that there are lots of companies that are selling for much less than their intrinsic value. I think international investors remember, the older ones remember the bust, but I think the younger ones are also put off by Japanese, that it's not English, so it's not a preferred stop for a dull market. Weirdly, it's prestigious to be a public company in Japan. And so there are as many public companies in Japan, with 3/8 of the population of the US, as there are in the US, where the chic thing is to be a private equity or venture capital company. This gives a wide array of companies that you can choose from. Lots of them are seriously mediocre in Japan, but there are some really fantastic companies, including quite a wide range where in the US you would have to invest in a venture portfolio or a private equity portfolio to get businesses this good. So management matters a lot. People talk about mean reversion. In Japan, at 0 interest rates, there are lots of companies that are selling not far from the net cash on the balance sheet. These are Ben Graham's net nets, and it's the only developed market in the world where you can find this amount of net nets anymore. They've disappeared in the US. The ones that are in the US are mostly losing buckets of money. So it's how long will this cash be around until it burns? but in Japan, there are lots of them. There are takeover protections and cultural dislike of hostile activity. And so takeovers are rare, and it's rare to force the intrinsic value to out. Therefore, you really need to have management who knows that they should distribute excess cash, they should buy back stock, they should grow if it's profitable. And it can be a fantastic market to invest in if you find those things.
Yeah, absolutely. That makes a lot of sense. And then maybe speak a little bit about your thoughts on investing in China and Hong Kong as well.
China is a more difficult market. China or Japan has stability and quiet, and the Chinese model is more constant, frenetic energy. Lots of things are always going on. There's lots of innovation, lots of competition, and you would be crazy to rest on your laurels in China. I mostly invested in Hong Kong because it was, according to the statistics, one of the freest countries in the world, at least for markets. And my problem with China is it doesn't have a free press, and it's useful for an investor to hear the other side and to hear all of the information. And I can't always get that in China. And so frauds go on, and you don't know whether they're supported by the People's Liberation Army or whether it's just bad form to inquire about fraud. But there are cases of fraud that go on, and the public can't get the information to judge for themselves. In the book, I talked about Sino-Forest, where it was hard to do the research. It eventually proved compelling that, that it was a fraud, but it was hard to sort out where the fraud was occurring. China is the world leader already and emerging leader in other sectors. It's the manufacturing workhouse for the globe. And so, I want to be there, but I don't like the lack of free press and lack of rule of law. That kind of freedom is needed to get the right information to invest.
Yeah, absolutely. That makes a lot of sense. And you discussed Sino-Forest there. In your book, you also discussed several other frauds, like Enron and Bernie Madoff. How have you been so successful over your career at spotting these frauds and avoiding them?
Well, in Sino-Forest, I didn't really spot it until quite late in the game, although fortunately it was, the stock got ahead of my estimate of intrinsic value, and so that was more luck. I had been antsy about Enron because I had had a bad experience as an analyst. I'm still not sure if it was the run-up to the fraud or whether the experience caused them to think about fraud. But as an analyst, they had been in town to find out about a trading loss blow up, and they had confessed that they had lost, I've forgotten how much as $1 billion, but had wound down the losses to like 150 million before disclosing it. I thought, wow, why had they not told the public about their massive losses right when it occurred? Why had they waited to, and this was back in 1987, I think. And I was a newbie analyst on gas pipelines at Fidelity. And so this was not something that I wanted, but it left me very cautious about, can I trust a company that would hide $1 billion loss and wait? And was it really reduced to $150 million? That stayed with me. The symptoms of fraud that they had were ever more complicated disclosure, in their 10Ks. There was lots of income that just didn't foot. There were subsidiaries. There were a whole series of Star Trek themed subsidiaries, like Jedi One, and there were a couple of them that sounded sort of kinky, Body Glove or something, where you wondered, what is that? The sales and assets were growing a lot faster than profits, which is never a good term in finance. You always want earnings and sales to grow in parallel, or in fact to leverage, to have rising profits on the same assets. So that was a warning. The cash flow statements looked terrible. The free cash, was just not there. They had profits, but not free cash flow. At the same time, business publications were applauding Enron, and the CEO, Ken Lay, was a PhD. I don't think it was a Ivy League PhD, but it was a PhD, and I was impressed. Even though I thought Rich Kinder was actually smarter despite the PhD. And they were doing innovative things. The trading operation was a new idea, and you never know whether a new idea is a good idea, a bad idea, until you try it. Yeah.
Yeah, absolutely. And when you originally met with Peter Lynch at Fidelity, you pitched him a savings and loan company. Can you tell us what that company was and talk about your thesis for it, please?
Yeah, I pitched a couple, but the one that I pitched was SFFD, San Francisco Savings and Loan. And it was benefiting from, interest rates were moving in its favor, so its interest margin was expanding, and California, being a strong economy, it had good loan growth, and the stock was selling for, I think, less than book value and maybe 3 or 4 times earnings. Peter Lynch had 400 savings and loans, so he already knew it, and my pitch was he was probably laughing at me, although the one that he was probably really laughing at was Chrysler, since Magellan owned millions of shares of Chrysler, and he knew much more about Chrysler than I did, whereas maybe we were more evenly matched on San Fran Fed.
Yeah, absolutely. And you've had a lot of massive successes over your career, whether it's Ross Stores, whether it's AutoZone, whether it's Monster Energy. Can you speak a little bit about how you found these companies originally and how you recognized their potential?
What's the value of a newborn baby? Hard to tell. Luck has a lot to do with it. In the case of Monster, I was at a technology conference, the American Electronics Association, and Monster Energy it got to be about 3:30 or 4 o'clock later in the afternoon, and I saw that there was a beverage service, and it was being done by Hansen Naturals. Hansen Naturals had a variety of fruit drinks that were special. They were sort of the juice bar for Hollywood, for the stars, where you could go and get your tomato juice with cumin and paprika, or whatever your taste was. And I thought that was kind of cool. And I had several of their drinks, but they also had an energy drink. And, it didn't thrill me, but I also thought that it was useful, because when I had a term paper to write in college, I would take a Coca-Cola and drop a no-dose into it, and it would leave this nasty depleted fizz on top, because I needed the extra caffeine. And so I could see, absolutely, why would you want an energy drink like Monster? Well, students writing term papers on deadline would want them. All sorts of people would want them. But I also had thought that the basic fruit drinks business was kind of nifty, because Snapple had been bought by Quaker Oats, and it had been smashed into Gatorade. And if you think about the customer base of people who would like bottled chemicals that were made for a football team in Florida, and a beverage company that is founded by hippies from New York, but hippies. What happens when you smash them together and put them under an oatmeal company like Quaker Oats? Boy, what a mess for the culture. So Snapple had been losing market share, and I thought that Hansen Naturals had a great opportunity there. It turned out that Hansen Naturals had been growing nicely every year. It had this energy drink, but the stock was selling for 10 times earnings, and it had a debt-free balance sheet. How can you not like a growing company at 10 times earnings that's doing something nifty that nobody else is doing? Red Bull, it was slightly aware of Red Bull, but the whole energy drink category wasn't very prominent. And so my investment was based on the fruit drinks, but all that ever mattered was the energy drink, which grew so quickly that, the earnings per share were equal to the purchase price of this stock within a very few years. It just exploded that fast, and it kept going. And as an investor, you get very few, moonshots like that. And I'd say, if you ever find one, just hang on. Here's where the meme traders are, right. If you ever find a stock like that, hold on for dear life. Most stocks are not like that, and but yeah, so that was just lucky.
And how about for AutoZone and for Ross Stores?
In the past, and intermittently, my fund has held TJ Maxx. TJ, had been a spin out. There had been a retail company that spun off different parts. One of them was TJ Maxx. I had invested in TJ Maxx, and as a cheapskate, I find discount retail appeals to my sensibility, and I can absolutely understand why a customer would want to shop there. I had invested successfully with TJ Maxx and kept asking, is anybody doing what you're doing? And basically, the only one that was a serious competitor was Ross Stores. And Ross Stores was in California, and TJ Maxx is in Massachusetts. So, there's plenty of country for both of them. But I thought, well, why not check that out? And what I found was they were growing as fast as TJ Maxx, maybe even faster. California is a great market for them. I was impressed by what Ross Stores called their micro merchandising, where they find out what customers at each store like. And so if they have a store that's near the beach, it'll probably have more swimsuits than their one that's inland. Let's see. And again, it was selling at a surprisingly low PE. It was generating buckets of cash, and between them and TJ Maxx, there was a lot of the country to fill in.
Yeah, absolutely. And the same, but for AutoZone?
Yeah. There, I think the analyst just pointed out to me that here's a cheap stock that's growing. Why don't you meet with them? And again, the attraction was that they were doing something that not many other companies were. At the time, they were working hard on managing their supply chain, where product proliferation meant that there were hundreds of models of cars. There are different model years. So there are hundreds and thousands of auto parts out there. And having a system to manage that is incredibly valuable. And the only other one that seem to be able to keep up with them, and that is O'Reilly, which the fund has also owned intermittently. The yeah, so I was attracted by a company that's doing something that no one else is doing, that's hard for others to replicate. And Amazon is really the only serious new entrant that I would fear. But I also think that they would wonder, is it worth developing a system to handle all those model years, all those models? It's just so much complexity, and the delivery systems. Amazon could do it, but really, wouldn't they find more gross margin dollars in pharmaceuticals or pharmacy? Like, there's where the dollars are probably better.
Yeah, I think that makes a lot of sense. And obviously, those were huge successes. What is an example of a past investment that failed that you made, and what did you learn from that?
Okay. Yeah. One of the tougher things about investing is that our minds blot out failure. They resist the thought that we failed. And we all want to tell revisionist history that says, well, I was really right, even though it looks like I was horribly wrong. So if you're going to rub my nose in dog do, I guess I might as well start with a big one. One was that would be Health South Rehab. Health South Rehab was and is the nation's largest rehab clinic. They were growing rapidly by acquisition, and it got to be at a low PE of adjusted earnings. Sort of notionally, I'd have to look at it, but if the adjusted earnings around 2000, 2001 were $1.35, the GAAP earnings were maybe a dime. And so there were huge gaps between GAAP and adjusted. Sometimes those adjusted numbers are informative and tell you more than the GAAP numbers because there are a lot of problems with GAAP. But there are also a lot of times when those adjustments are meant to be flattering, and you don't want to believe them. And I think I was comparing the $14 stock price with the $1.30 of adjusted earnings and said, wow, that looks like a 10, 11 PE, looks pretty good. And not with the dime of GAAP earnings, which would have been a pretty high PE. And I also wasn't looking enough critically at the cash flow statement. The problem turned out to be that Health South was cheating the government or defrauding the government and was overbilling on healthcare procedures. And this dragged on for a couple of years, but it turned out that indeed they were defrauding the government. Why was the cash flow not there? Because they weren't being paid on some of these fraudulent payments. And so this was a sort of cult of personality stock, where the founder had been a rehab therapist who had kited this company from Birmingham, Alabama, to a nationwide company. And he would hire bands to play for employee functions, and even played in one himself. And so the investor relations guy had been an actor on a TV series called The Wonder Years. So there was that going on. As the accounting problems and defrauding the government closed in, the stock started to fall, and the CEO sold back to the company almost all of his stock at an above market price just before some of the disclosures came out. And when it was disclosed that he had sold, the stock was already down by about 40%. I wrongly held on for dear life, but it became clear that they weren't going to release, HealthSouth would not release any financial statements soon. And so I sold the stock. It turned out that the accounting restatements were, it took a couple of years for them to get fully restated, but they were not terminal. And I had sold out near the lows. So I guess, what do I take away from this? If a company is cheating the government, get out. If there's accounting fraud, get out. If operating cash flow is not in parallel with adjusted earnings, you should believe the GAAP earnings. If it's not even in parallel with the GAAP earnings, you probably have fraud. And be wary of charismatic CEOs who promise too much and feel pressured to maintain their public image by doing unethical things.
Yeah, absolutely. Thank you so much for sharing that case study with us and those lessons. Can you speak a little bit about how you think about the intrinsic value of gold, please?
I think gold is the most idiotic thing because it has no income, and as a investor, you want to invest in productive assets that earn a rate of return. However, we live in a world where there is accelerating inflation and negative interest rates. So gold is still a barbaric relic, but it's no longer completely idiotic. in loose terms, people have tried to argue that if you take the value of an ounce and compare it with the value of a house or some consumer goods, that it holds the value over time. And I think there's some truth to that. I don't think the value of gold will ever go away because it's shiny, it's used in art, it's used in wedding rings. So I think it will always have a value, although it's like a lot of things in the financial markets, it's believed because others believe. And so I don't think it has a true intrinsic value, but it probably does have an approximate purchasing power. A value investor would probably figure out what that amount of purchasing power is and say, is it above or below what that purchasing power has been at different times?
Yeah, that makes sense. And what are your views today on oil, and are there any other commodities that look interesting to you?
I think that you should never kill an industry until you have something to replace it with. And, I guess I'm totally on board the idea that we must do an energy transition. Fossil fuels need to be replaced with less carbon emitting fuels. The problem is that relative to a kilowatt of energy produced, a lot of the alternate energies use more energy as an input into producing it. So what they call your energy return on investment is much lower for the alternate energies than it is for fossil fuels. All of the ESG has come to even big companies like Exxon by force because of the shareholder activist. But the capital markets have also been telling them, you destroyed so much capital in the last couple of years. At one point, the price of oil oil futures was notionally negative, which is you couldn't give the commodity away. So how are the companies going to make any money? And there's the problem of how do you manage a business that you know must go away or change form in the next 10 years, 20 years? The net result of that is that energy exploration has collapsed. New supplies of oil are not coming on to replace the depletions. That would be good if alternate energies were there to take up the slack, especially if battery technologies had been ready to serve the alternate energies that produce intermittent power. So I think we're going to have a very tight energy shortage for at least a year or two because of the lack of investment, because of the ESG pressures, because of a lot of things. And Putin throws something else into that mix. Geopolitics, I have no edge on, but it does mean that oil will probably be very tightly supplied, and gas. In cognizance of those ESG pressures, I am trying to focus on gas companies more than oil companies more than coal, companies that are trying to explore newer and cleaner energies, such as carbon storage, carbon capture. There's a company called Denbury Resources that has interesting storage capacity there, or hydrogen power. So I'm looking for ones that are trying to prepare for an energy transition. Reducing methane emissions is probably more easily done than reducing carbon emissions. And I think that's something that ESG people should ask management, so energy companies, to work on.
And are there any other commodities that look particularly interesting to you today, the setup for them?
Nothing is forever in commodities. They're in demand today, and you have to check tomorrow to see if they've become oversupplied. It's commodity markets at work. That said, the energy transition requires an incredible amount of absolutely filthy mining. How do we feel about electric vehicles that use cobalt, which gets mined with child labor in the Congo? Well, it's all for a good cause, but no, I don't feel very good about using forced labor to produce it. Mining is a filthy process, and so nobody wants it in their backyard, or maybe even in their country. So electric vehicles will require a lot of cobalt. They'll require a lot of rare earths. Most of the rare earths are found in Asia and China. And so they're tougher to invest in. Copper, a lot of that will get used in the energy transition. And so you have to get comfortable with the political stability of Peru or Indonesia or other places, since the biggest supplies are in places where I wouldn't choose to invest if I didn't have to, given the political stability and rule of law.
Yeah, that makes a lot of sense. And can you discuss some of the key lessons that you learned from Peter Lynch?
Peter always believed that you should look for that one more fact, make sure that you are up to date, that because there is always something that's changing or new. Peter was fantastic, is fantastic at the read across. Long ago, I was Fidelity's natural gas analyst, and so he would, if I told him that gas prices in offshore Louisiana were up, he would wonder, what's that do for gas pipelines? What's that do for gas utilities? What's that do for the petrochemicals industry? And he was great at reusing the same information in other industries. Peter has a remarkably flexible and open mind. So he's quick to see things that don't fit with your view of the world, and sort of training yourself to do that is hard, but I think it's really important to see, how might I be wrong? Well, here's a fact that says I might be. And it might also give you a different insight that moves you forward. He didn't automatically exclude industries, and was willing to consider anything. But he also had a shutoff valve. He had what he called the 2-minute drill. I could pitch a stock to him for 2 minutes, and if he really didn't like it, he would shut me off after a minute. This applied to all the analysts. He would shut us down after a minute, and if it was really great, let you go on for more than 2 minutes. So he was willing to consider anything. Actually, I think that is why I got the interview with him. I applied for at many other places and had called, and I was just shocked when he picked up the phone, when his secretary put him through. And I think it was because he was willing to consider for 2 minutes, is this a good candidate?
Yeah, absolutely. And do you use either quantitative or keyword screeners in your research process? And if yes, how so?
I mostly use screeners like FactSet or Bloomberg for thematic type screeners, where I'm wondering what energy companies are there in the United States, and how do they compare on some metrics? Are there energy companies in Asia that could be interesting? Are they growing faster than the North American energy companies? Are they more profitable than the North American companies? All the things that you can screen for are indicators of value. They're not value. And so, yeah, I look at them, but it's a starting point, not the ending point.
Absolutely, that makes a lot of sense. And You spoke a lot about including or excluding industries earlier. Are there industries that you exclude from investing in? Are there countries that you don't invest in? What type of minimum market cap or liquidity criteria are you looking for, etc.?
There are industries that I don't understand, and so I stay away from them. Mostly the fastest growing technology companies and early stage biotech companies. They don't have profits, and if there's going to be a scientific or pharmaceutical breakthrough, I'm not the one to be able to judge the advantage there. Fidelity has some really smart people like Irene Kontopoulos, our biotech analyst, who are great at that. But as a portfolio manager, and she really can handicap this research project. She has a PhD, and so of course she can judge that better than I can. But as an investor, I have to know enough to validate the conclusions myself, and I can't in some of the fastest moving tech areas and early stage biotech. Once a drug company has a phase 3 project or has drugs on the market, I do invest. So I have some of what are called biotech companies, but I think of them more as science-driven pharmaceutical companies than biotech companies, which I think of as the early stage biotech.
And what about, are there any countries that you don't invest in?
I stay away where there isn't rule of law. So China is an ambiguous case. Russia, clear cut that there is not rule of law there. Yeah, you're in any place where there's not rule of law, I don't want to go. Any place where,
yeah, that makes a lot of sense.
Yeah,
I'm sorry, go ahead.
Or high inflation. Turkey sort of has rule of law, but it also has high inflation. And so that's a place that I don't want to invest.
Yeah, absolutely. I think that makes a lot of sense. And for a concluding question, how do you help to counter psychological biases like group thinking and anchoring at Fidelity?
It's hard because all of the people at Fidelity are so smart. A lot of them attended Ivy League universities. They're all ambitious. They're all trying to do the right thing. And a cynic would say, boy, they're not very diverse. They all went to the same Ivy League schools. They all got good grades. They all have been trained to think about investing in the same ways. And I resemble that remark. And so fighting groupthink is a hard thing. One of the tools that people have for fighting groupthink when there's an important decision, is to have people vote on paper and then reveal the then calculate the votes afterwards, because it's hard for me to think of myself as a senior person, but I guess at my age, I am a senior person. And so if I'm full of shit, younger people are not going to say, you're full of it, Joel. But they have to be free to say that. And I think that's why Peter Lynch's idea of listening to any idea for 2 minutes, shut it down and you don't pursue it if you don't agree, but try to give time to ideas that you don't agree with or people that you don't agree with. Try to understand why vaxxers might be right about anti-vaxxers might be right about infringing their civil liberties, or if you're an anti-vaxxer, why you should pay attention to public health.
Yeah, absolutely. Thank you so much. This is a really terrific session, and we really appreciate you taking the time out of your busy schedule to speak with us today.
Thank you.